The bull market we've been in might finally be coming to an end, and there's two main things I want to talk about. There could be a lot more, but I want to talk about two specific things in this video that might indicate that the bull market is about to be over. Over the last year, we're up 27% on the S&P 500, and year to date, we're up just under 10%, which is a great year, by the way, because we're only 4 months in, and the average yearly return of the S&P 500 is roughly 10%. And right now, we're just barely off an all-time high in the S&P 500 and multiple other indexes. So there's two things that could stop this bull market in its tracks and stop us from hitting all-time highs anytime soon. We're going to talk about those two things in this video, but first, if you're new here, I'm Austin. I'm a co-owner of cloudmusicsuite.com. I'm also a stock market investor. If you're not subscribed to the channel, become one of those 3,000 or so people. I'm not sure exactly where that number is right now, but become one of those subscribers. Click the subscribe button. It means a lot to me. Thank you so much for doing that. Let's jump into the video. So the first thing that's troubling, speaking specifically on the S&P 500, I've got a 10-year chart of the S&P 500 PE ratios. That's the price to earnings ratio. Over the last 10 years, there's only been one period of time that was actually higher than we are right now today on the S&P 500 PE ratio. And that was the bubble market after the COVID pandemic from April 2020 through March of 2021. Not only did our earnings get crushed in a major way for companies, which made the PEs go up, but then we went into a crazy bubble bull rally and countless stocks were flying to the moon. Past that though, there hasn't been a single time in the past decade that we've been as high as we are right now on the S&P 500 PE ratio. So as of recording this video, we're sitting at a 28.22. which is substantially higher than the median and the mean of 15 and about 16 respectively. So what has to happen from here in order to get that PE ratio down is one of two things or a combination of both, right? One would be stock prices come down in a big way. That would mean major pullback for the whole index. And when the index goes down, some individual stocks get pulled down 2x, 3x, 4x of what the market overall drops. So that could mean big pain for a lot of people's portfolios. Another thing that could happen, and this could happen at the same time as stock prices are coming down, is that company earnings get better. I do believe that company earnings are going to continue to get better over the next 12 months throughout 2024 and even throughout the first half of 2025 as inflation numbers come down, as the Fed starts to bring rates down, etc. We're going to talk about inflation and rates in a little bit, but I do think earnings are going to get better, which will also bring that PE ratio down. So if we get a little pullback and a decent boost in earnings for the S&P 500, we could level out at maybe like a 23 to a 25. I would feel a lot more comfortable buying a lot of stocks in a 23 to 25 S&P 500 PE range. I've decreased my buys in almost every company a whole lot lately. There's only been two companies I'm buying over the past month, and that's SoFi and actually Whirlpool Corporation, which is a really boring stock. It's a value-related stock. It's a dividend stock, buying it for the turnaround opportunity, and then SoFi is one of the big growth opportunities that I see in my portfolio. Past that, I might have bought a few shares of PayPal. I can't remember off the top of my head if that was in the past month, but so many stocks, I have decreased my buys substantially over the last little bit. I would love to feel more comfortable out there with some stock pricing so I can go ahead and increase my buys again. And then the other thing that's worrisome has a lot more ripple effects than that S&P 500 PE ratio, and that's the inflation numbers. So inflation numbers came out yesterday. We got the CPI report. It was at a 3.5 on a year-over-year basis. That's higher than expected. 3.4 is expected. That's higher than it was in February at the 3.2. And that's 3 months in a row of higher than expected CPI reports. That's not a good look if we think the Fed is going to cut rates this year. The market has priced in that the Fed is going to cut rates. Expectations have decreased for how many rate cuts and how much they will cut throughout the year, but there's still rate cuts on the table, it seems, inside of the year of 2024, which could mean good things for stocks, especially smaller cap stocks, because it's going to decrease the pressures of those higher interest rates, having to pay more for debt, etc. It also puts the consumer in a good spot. It takes a little bit of time to put the consumer in a better spot by lowering rates, just like raising rates takes a little bit of time for it to hit the consumer. It's not an instant thing, but the market is a forward-looking market. We're trying to figure out what's going to happen 6 to 12 to 18 months from now. That's what gets priced into the the market, something that's going to happen in the future, not necessarily what's happening today, but what might happen 6 months, 12 months, 18 months down the road. So the ripple effects from the CPI could be huge. One, if inflation keeps on going up and going out of control, and dare I say we get back into the fours, I'd say rate cuts are probably off the table, and the Fed might start flipping to hawkish and start talking about raising rates again if we hit back into the fours for the CPI. And if that happens, the market is going to overreact in a massive way. Wall Street's going to panic and shares are going to dump like crazy. One good thing about that is we'll be able to get stocks at much lower prices, right? The PE ratio on the indexes is going to come down massively if we get share prices coming down big time. For a long-term investor, this could be a great opportunity. That's one of the reasons I've actually stopped buying as much, because I believe that we're going to have a weak Q2 overall, and I'm going to be able to get some good buying opportunities late Q2 or early Q3 of 2024. I could be wrong, but regardless, I've got a little bit more cash than normal sitting on the sideline. Roughly 15% of my brokerage account is in cash right now. That's still a small number, meaning I'm 85% invested. I haven't sold any stocks to do that. I've just been building up cash in the accounts. So my general view is that I think it's very likely that we get a weak Q2. Also, interestingly, in an election year, Q2 is normally a weak quarter. Q1's pretty strong, Q2 is pretty weak, and then Q3 and 4 are normally pretty dang strong in an election year. And if you forgot, we are in an election year, so it's just interesting how it's seeming to line up that way like it has in the past. What I don't plan on doing as a result of this is selling into the weakness. What I do plan on doing as a result of this is buying into the weakness. I'm not going to buy willy-nilly. I'm still going to make sure I'm buying the specific companies I want to hold at prices I want to hold them. But when the whole market comes down, it brings every stock with it, right? Some stocks get disrespected way more than they should just because the market's coming down. Maybe they're seen as more of a risk on asset or a speculative asset. Those type of stocks, those higher growth names, are going to get hit a lot more than the value names normally. So it could create some really good buying opportunities for us, but it could mean the end of the bull run. So the fun might be over for a little bit, but on the other side of that, great buying opportunities are probably going to present themselves. I want to know what you're doing out there. Do you think that either of these are risks to the overall market? Do you think we're going to see a decrease in share prices overall throughout Q2? Do you think we're still going to see rate cuts? I'm interested to hear what you guys think on this. Thank you so much for being here. Have an amazing day.